market, I often get asked what to do with our investment. On one hand, you got your cash and your fixed income or your bonds, which basically don't even keep up with inflation, which means that you're losing your ability to purchase goods. On the other hand, you have your stock market, which we're living basically in an economy with many turbulence. And let's face it, it's not like it's particularly cheap at this point. So what are we supposed to do? First, let's understand one thing. One strategy doesn't fit all. In every investment strategy that you should have your cash component for your liquidity, your income component that gives you your secured income, and your growth component. Today, I'm going to talk about the growth component. This is the section of your portfolio that provides you with the greatest return, but also the greatest volatility. Now, let me first, as I'm talking about volatility, explain the difference that I see between volatility and risk. A lot of people use them interchangeably, but the truth is, risk is, let's say you have a stroke and you don't have the investments put aside or a critical illness insurance, and you don't have the money necessary to take care of yourself for your medical expenses. Or you didn't plan properly for your retirement, so in the middle of retirement, you end up having to move with your kids in order to support yourself because you spent too much or you didn't have a proper strategy. Those are risks. Risks are your enemies. On the other hand, you have volatility. Now, volatility is basically the movement of a security, a portfolio, or basically the market going up and down. Volatility is your friend. It allows you to purchase security at a great price and also to make money, because if there was no volatility in the market, you wouldn't make money. That being said, in today's world, if you buy a company at fair market value, it's really hard to make money, right? Because the companies that we actually want to own are either at fair market value or overvalued. But on the other hand, the ones that are cheap are the ones that you really don't want to own because you're going to end up in a value trap. So I'm going to give you a strategy a little similar to the one I've discussed before. If you remember a few videos back, I mentioned about shorting puts, right? Which basically meant that you buy your stock at a predetermined price. So I'm going to elaborate with that strategy. So today I'm going to talk about Advanced Micro Device, which is also known as AMD. They're a semiconductor company that I like, which is in a growing sector as far as I'm concerned. They design and produce microprocessors that are outperforming those of Intel and NVIDIA at this point. So that being said, AMD does trade at its full value of 75. So what can I do to make money and still protect myself on the short term? So what we're going to do is we're going to start by, on day one, I'm going to buy 100 shares of AMD at 75 at the market. And then I'm going to sell a put at 65, which means that I'm making a commitment that if the stocks ever goes down below 65, I will purchase it at 65. And I'm going to get $850 for that. And at the same time, I'm going to sell a September call at 90, which means, again, if the stock at this point rises above $90, I will sell it at $90. So I'm going to get $1,050. So at the end of the day, I output $7,500, which was my initial cost. I received $1,900 worth of income. So my cost on day one is $5,600, and I own 100 shares of AMD that are worth $7,500. Now, by today till the end of September, if nothing happens, I made $1,900, which basically means that I pocketed 25%, which is not bad for a year returned. Now, what if happens if in September, all of a sudden the stock is at $60? So I still own my 100 shares, which cost me $5,600. But remember, I sold a put at 60, which means that at 65, which means that I do have to buy 100 shares at 6,500. So my new cost is basically $5,600 plus 6,500, which is $12,100. My 200 shares that I own now are $12,000. So the shares actually drop by 20%, and at the end of the day, all I lost is $100. So you can see how much this can give me a bit of protection on the downside. Now, on the other side, what happened if the stock actually raised to 110? Well, now my 100 shares are worth 11,000. This is great, except I promised I was going to sell them at 9,000. So because I sold a call at 90, I have to sell them for 9,000. But remember, I still keep my 1,900 of income that I received originally. So it's the same as if I sold them at 109. So $90 plus 19 gives me 109. So on the upside, if ever the stock ends up at 110, I end up making a 45% return, which is not a bad return considering I hold it for a year. So as you can see, in volatile market, you can also make money. There's a few steps to keep in mind though. When you buy a company, make sure you buy a company that you like. That's the first. Second, make sure you understand the value that you're willing to purchase the stock at and the value at which you're willing to sell it at, so you can put your range. Third, keep in mind that you need the liquidity, that if ever the stock goes down, you're going to have to purchase it. So make sure you have the appropriate liquidity on hand. Fourth, remember one thing. When you're dealing with equity, it's never short term. Know your time horizon. If you need the money next year, don't invest in equity. Keep it in cash or equivalents. And 5, be disciplined. Don't let your emotion make the decisions. That's the best way to lose money. If you follow these steps, I can assure you that you will do great. So I hope you enjoyed this video. If you have any more questions, please don't be shy. And you can always look at previous blogs that we've put on our website at www.3dfinancial.ca. And until next time.